So what is equity in real estate? So I've already gone over debt and broken that down. Now I'm going to talk about what equity is and why it's one of the most important parts of the capital stack and why it's one of the most difficult parts of the capital stack to actually source. I'm going to go over what it is, some common terms used when discussing equity, and how it's typically structured. My name is Sisad Mbuya. I'm a commercial real estate consultant, closed a couple hundred apartment units, and have dealt with various different ways of raising equity. So let's get into it. First, what is equity? So equity is going to be the actual part of the property that is owned by the investor or investors. So to be able to find out the amount of equity you have in the property, take the property's value minus the debt amount. So of course, value can fluctuate. You may have bought a property for 100,000 a year ago or 10 years ago, and now it's worth 200,000. You want to use that $200,000 value. So if you have a loan for, call it 150,000 on that $200,000 property, now you have equity of 50,000. So the difference between debt and equity is debt is owed because it's money that was borrowed, whereas equity is owned. So the ownership of the property itself, and this is really with any type of asset, not just in real estate, the ownership is going to be equity. And that equity can be yours, just you as the investor, or if you have other investors, you have limited partners that invested and put their capital in. Now, all of you guys have equity and you kind of determine how everything is split up and shared. Now, equity is going to be a lot more risky, but at the same time, it's also going to have more upside. Debt gets paid first. So, saying that $200,000 property, say you foreclose on it and you have, call it maybe a $200,000 loan amount, then all the entire property value is going to pay back the lender that gave you that debt. And everybody that invested equity, they're not going to make any money. So debt gets paid first. But on the flip side, if that property is worth 200,000, if say you had that loan of 200,000, but that property sells for 400,000, then that's still that 200,000 gets paid to the lender. They don't get to enjoy any of that upside, and that remaining $200,000 in profit is the equity that is enjoyed by the investors and everybody that put in and owns a piece of the asset. So why does equity matter? So as I mentioned, equity actually has the upside. So it has more risk, but it has the upside. And that's really where most of the profit is made in any type of investment, is in the upside. You're buying a property or buying an asset with the expectation that you're going to be able to increase the value of that asset. Now, when you increase the value, you actually get to keep the value after all of your debt is paid off. So that's where a lot of the upsides made. That's where people get rich, really, honestly, is in equity by owning stuff and being able to increase the value of assets. That's also where the control is. So the lender typically doesn't have much control over the property. They have certain things that they can do in terms of making you keep certain reserves, holding back some money, and then foreclosing on the property. But as far as like the decisions that are made, they're going to actually impact the operation and the value of the property. That's where the equity owners are. That they're going to have the control, and not all of them, because you have something. Sometimes you have general partners, but if you have investors that just put their capital in and they're passive, they don't have any control, and it's really just going to be the operators. But long story short, the equity means control of the property, and then the equity splits. How you actually divvy up and structure the equity is going to determine the amount of profit that each investor is going to be able to take if the property and the asset does well. So equity's role in the capital stack. Equity sits at the top of the capital stack. So if you want to know more about the capital stack, watch my capital stack breakdown video on my YouTube channel. But essentially, you have debt at the bottom. There's different types of debt. You typically have like a senior debt in most cases, and then every now and again you have a mezzanine debt, which is a layer of debt that sits above that, and then above that is going to be equity. Equity can come in two types. Well, there's several different types, but two main types, which is going to be preferred equity, sometimes abbreviated pref equity, and then common equity. So some of the stocks, preferred equity is going to be um, paid out first. It's a little less risky, but you also have limited upside with preferred equity. And then with debt, debt is going to be paid out before any type of equity. So the capital stack ranges from lowest risk to highest risk, and lowest upside to highest upside. So as you go up, you're increasing your risk, but you're also increasing your potential to make a killing on the asset. So equity is going to sit at the top. Common equity is going to be the most risky and is going to be paid out last. So if you invest common equity or have common equity in asset and something happens, it goes left, then you have to pay out the debt first. So if you foreclose on the property, any of the proceeds from the foreclosure, the auction, the sale is going to first go to pay off your senior debt, then it's going to pay off your mezzanine debt, then it's going to pay off your preferred equity if you have some, and then it's going to pay off the common equity. So just keep that in mind. All right, so where do you actually get equity? There's a few different places. So first and foremost, usually when you're starting out, you're gonna start with your own capital. Even when you're really experienced, you tend to have to put your own capital or want to put your own capital into your projects or your real estate investments. But typically, you're gonna start with your own capital, and then as you scale up, you get more experience. Then it's a little more easy, makes more sense to raise capital from other investors, so you can have more to be able to scale quicker as opposed to being limited by the capital you have in your accounts. So that's usually where you start off. Then you also have friends and family. So if you have a network of people within your family, especially that's like that next step. Say you're investing on your own $50,000 a project, then you get to a point where you want to buy $1 million property and you might need a couple 100,000. Say you raise from 50,000 from your uncle, 50,000 from your dad, 50,000 from one of your homies you went to school with that's an engineer. So you can get sources, get capital from different investors, and then let them get some equity in it. Then you also have private investors. So this may be like high net worth individuals. So they may be in your network, they may be referred to you, and you build a relationship with them. But that's typically going to be like a syndication where you're going to get retail investors. There may be lawyers, doctors, engineers, people in entrepreneurship that want to invest in real estate but don't want to actually do the work that comes with real estate. So you can pull their funds together in a syndication, which I'll do a whole other video about what a syndication is. But syndication essentially means group. So you're investing as a group. You're raising capital from investors who aren't trying to be active, and you're going to do all of the work. But all of y'all get a piece of ownership. You're going to distribute returns to them, and that allows you to be able to scale and grow your portfolio quicker by raising capital from others. Then once you really get good and you have the track record and you have the relationships, then you go for the institutional funds. So institutional capital is going to be the most challenging to get a lot of times, and it typically is going to need much bigger dollar amounts. So a lot of times institutional funds, they may not want to invest unless it's like millions of dollars, maybe like a million, 2 million on the very, very low end. Sometimes 5 million is going to be the minimum for some. But a lot of times, you really going to these big, big companies, life insurance companies or just super big private equity firms, they may be looking at minimums of 10 to $20 million of investment. So really getting up there in scale. So they have private equity firms, which are essentially these professional capital raisers. So there's firms that essentially will just raise capital from different investors and then deploy that capital into projects that are ran by experienced, very experienced operators. They want to see a very strong track record in whatever it is you're doing. If you're doing multifamily, they want to see a track record of multifamily. If you're doing hotels, they want to see a track record of hotels and a pretty extensive track record in order for them to be able to invest and want to invest in your project. So it's very important that you have that track record, but these private equity firms can give you 90% of your equity or sometimes even 100% of your equity, usually like 90% though. They usually want to see you invest some of your own capital. But they'll give you a huge chunk of the money instead of you having to run to 20 or 30 different investors. You can just go to this one group that's going to give you most of the funds. But they're going to want to see a track record, and sometimes they may want to have a little more control over the project because they're the main investor that's giving you all this money. And then you also have family offices at the institutional level. So these are going to be investment firms that will serve one or multiple high net worth families. So it's a way for these families to build their wealth and maintain their wealth and grow their wealth over the course of generations, as opposed to just leaving like their offspring or their children to manage it. Then you also have joint ventures and you have co-GP. So this is another way to invest with other real estate developers. So it may be you're an experienced investor, then you find another experienced investor. Instead of you raising money from a whole bunch of passive investors, you might be able to just pull your capital together and then buy a property. So that's another way. just buying property with other active investors instead of having to raise money from a whole bunch of passive investors to get a deal done. So here are some common terms to understand when it comes to equity. First is going to be a preferred return. So a preferred return means, like, say you have investors that invest into a project, into your deal. Say you guys have a certain split. Instead of saying, all right, you get your percentage, I get my percentage, you incentivize yourself, you incentivize them to invest in your deal by offering a preferred return, saying, all right, you're going to get 8% of your money annually. So if you invested $100,000, you're going to get $8,000 back a year as a preferred return, meaning your return is preferred. So you get that return, you get that $8,000, and I have to pay that out to you before I can take any of the returns myself. So that creates an alignment of interest because I don't get paid unless you get paid. So the money after that $8,000, then we can start talking about how we split that up. The preferred return just allows the investors or whoever you want to structure to get a return before anybody else takes any money. Then you also have capital calls. So a capital call is going to be anytime you raise money from investors and you're doing a project. Say you hit a snag, at some point you start running out of cash to be able to keep the property going. Maybe you need to renovate units so you can get the tenants in there so you can then start cash flowing, but you can't, you ran out of money to renovate units. You may do a capital call to be able to get money from your investors to be able to then go back and renovate those units. As an investor, like, you want to avoid capital calls at all times. If you're the person actively doing that, you do not want to do a capital call to your investors. It's usually a last resort to prevent foreclosure, but you don't want to, like, because you've already mismanaged the money, and that's why you're running out. So to then go ask for more is just not a good look. And then from an investor who's put money into the deal, it's like, damn, I put in $100,000 2 years ago. Now you want to ask me more money? And if you're asking for a capital call, that means the deal probably isn't cash flowing anyway. So that means you, as the operator, that I invested my money into your project, you're not giving me a return on my money like what was the plan, and now you're asking me for more money. So it's just not a good look. You want to avoid it as much as possible. Another term is going to be hurdles or a waterfall. So it's typically a way to structure it where, say, like in the preferred return example, say there's a 8% cash on cash preferred return. So you get that money back, or I pay that to my investors before I take any money. So a hurdle may be, say, like once we hit a certain return metric, it's typically going to be with IRR, your internal rate of return. But like once you hit that metric, say up until a 14% IRR, I, as the operator, the person who's actually doing the deal and doing all of the work, say I don't get any money. I have 0% of the cash flow up until I give you that 14% IRR. Then say up until from 14% to a 17% IRR, that amount of money in that gap, we split 30-70. So I get 30%, you get 70% as the investor who put your money into it. So up until 14%, I get nothing, you get all of the cash flow. Now we're splitting it 30-70. So I get 30%, you get 70% up until you've got 18% of your 18% IRR. So now everything above 18%, we might split 50-50. So essentially, with every return that's met, I get you your 14%, then I can start taking money. Then I get you your 18%. Now I can start taking more money. So now it's incentivizing me to get a great return, and you take on less risk as the investor because you get more of the money on the front end, or you get more of the money first before I can really start taking money. So it's just a way to structure it that aligns the operator who's doing the project and the investor who's putting their money in. So now we're both having alignment of interest. So that increase in percentage is called a promote. And that's the last term I'm going to go over. A promote, sometimes called a carried interest, usually like outside of real estate. Or carried interest may be in like other types of private equity. You're investing maybe in like businesses or something like that. But a promote is a promoted interest, meaning you get a bigger share of the profit once a certain return hurdle is hit. Once you get over that level, then you have a promoted interest and you can make more money. That's really where a lot of wealth is built. Okay, now let's get into common equity structures. So there's a few different ways you can structure equity. Of course, equity is going to be a part of the capital stack that sits above debt. So equity is typically going to be like maybe 30 to about 40% of the capital stack. So that debt is going to make up the rest of that 60 to 70%. And that's in a standard senior loan and equity structure where there's only those two layers of the capital stack. Of course, you can have mezzanine debt or preferred equity in there as well. They change things up. But in terms of like your regular run of the mill, you're going to have just debt and equity. So, how you structure the equity itself, just the equity portion, a common structure is going to be split 30-70 or maybe 80-20, but 30-70 is probably what's more standard. And that's going to be 30% to you as the operator, the person who's doing the deal. And then if you raise capital from like a private equity firm or from you're doing a syndication with multiple investors, they're going to get 70% of the equity. That's standard. So even though they may put in more of the actual the equity itself, that's that typical 30-70 split is, kind of what that the share is going to be. A lot of times you're going to have a preferred return though. So a preferred return, as I mentioned earlier, even though you have maybe 30% of the equity, when it comes to the cash flow, you're not actually realizing that 30%. You're not getting any of that. The LPs, your limited partners, the investors, they're going to be getting that 8% until they reach a certain return metric, and then you can start to participate in the cash flow. So preferred return is going to be very common, and in most cases, going to be kind of standard. A lot of investors are going to look for preferred return to invest in your deal. So that's kind of industry standard. You're going to use it most of the time. Then you can also have a promote structure, a promoted interest. So that's again, you have your a preferred return, then you have a hurdle, and then once you get past that hurdle, you get like a bonus of which is a promote. You have a promote, which is a bonus. You get a bigger share of the profit beyond a certain point. That's a promoted interest or promote. And then you can have a waterfall structure where there's multiple layers where it works in the same sense is, there's a preferred return, you got a return hurdle, but a waterfall means there's going to be different hurdles where like every hurdle that you're able to get over by just having enough profit, then you're able to, as the operator, as a general partner, you're able to realize more of the cash flow past that point. So these are different ways that it's structured, and however you want to structure is going to be dependent on the deal, what makes sense, incentivize investors. But there's a lot of different ways you can structure it to make sure that it's a win-win for all the parties involved. Okay, so that is my video on equity. Hope you got some value from this. Please go ahead, like, subscribe, share with somebody else, leave comment. Let me know what you want to learn more about. But yeah, that's equity in a nutshell. If you have any questions, and I'll see you in the next